I mentioned poker very briefly, but I want to go deeper into another one of our favorite analogies. And this is, I came across this write up on X by the Stanford econ prof, Kevin Mack. I really like his stuff. He's just he tries to be really objective minded. And you could see how he doesn't succumb to biases often. And he wrote a thing about poker. So I'm sure he's a serious poker player. And there's something I really liked in which he explains the difference between adaptation and variance. But the context of this was a familiar refrain. I don't know how often you felt this, Badge, that pro players, when they get involved in a bad game, say they were so bad I couldn't beat them. Because what he's really referring to is what a bad game means is that the players are doing God all knows what, and all your high level game theory and probability and all this stuff mostly goes out the window because they're not even thinking on those levels. So to backtrack, so how do you beat a game like that? So the first concept I just want to briefly elaborate on is adaptation, which I think is familiar to most people in the common sense term. That as in poker, as in the markets, context changes. Easy example is in poker, if you're playing with really good players and everybody's playing what we call tight, they're playing the best hands, right? So they're throwing out a lot of junk. They're not approaching it in the gambling way. And so if everybody's playing tight, it's to be successful, you can't really play tight and expect much alpha because everyone has the same playbook. So in that moment, you kind of need to loosen up your starting criteria and do it in a way that's, kind of shifty, but you have to adapt, is the point. Obverse is true. If everyone's playing whatever, you got to tighten up and so forth. Analogy to the market, I would say easy to understand is when the market is really lofty and everyone's talking about their next Ferrari and going, YOLO, FOMO, all of this and that. That's when I start looking more closely at the stocks that have a safety of margin, more of the beaten down stuff, more of the blue collar kind of stuff, or things outside of the high growth multiples, but I'm adapting. Likewise, when rates go down and so on and so forth, I take more risk. But you can't, it's a simple idea. It's wise to change when the circumstances change. So easy to understand, right?
Yeah.
I think the more interesting thing and more useful lesson in this particular moment we find ourselves on September 8th, 25, is going back to this quote when things start getting more chaotic, meaning when variance goes up, there's call it more bad players at the table. You're seeing all kinds of stocks going, rocket ship emojis. The mistake is variance chasing, or in poker, it would be adapting to the level of the variance, meaning increasing your variance. So if everyone's playing like shit, all of a sudden you're like, I can't beat this because it's so chaotic. And you start playing like shit because you basically kick out all your fundamentals out the window. The play here, rather, is to remember that in the short term, the variance is going to do what it does. You're going to have bad cards winning. But if you stick to the fundamentals and you then play correctly and you really dig deep into the patience bin, then you can survive that variance, and then your good cards that you're holding will in the medium to longer term beat that bad game. And in market, it's basically, I think the lesson here is be very careful chasing the stuff that merely has the huge variance. If you have the long term, investor mental frame on. So I'll pause there. How's that land for you?
Sounds like I'm listening to myself talking. Yeah. Just that's exactly right. Yeah. Don't chase the complete chaos just because of its chaos. Like find quality, try and be a bit counter cyclical to what the rest of the market is doing. And when things are volatile and wild, like retreat to a place of kind of safety and security a little bit.
Right. So a disciplined investor doesn't copy that behavior. They might take small measured positions against it, accepting the variance and let fundamentals win over time. And as a side note, I don't know, it doesn't feel like I'm arguing against myself, but when I took that little flyer position in the open door technologies, it's kind of nuts. Actually, today it's like up 76% in 2 weeks. Right. So that's what we're talking about. But a couple of things. I knew I'm not fooling myself on this in any way. I'm not like abandoning my fundamentals. So I knew the game that I'm now playing. And I also liked the other things I talked about in the previous episode. So listen to episode 96 when I kind of lay out the bull case that's beyond mere FOMO and YOLO and stuff. And I sized it appropriately. I'm not just ruining my whole game. And so I think I don't know, this is the art of investing, right? I think there's ways to, if you're very deliberate and aware of what you're doing, to sort of try to balance these two as long as you don't fall into obvious errors. So